Well, it was reportedly late last Friday, the board and management of AGL Energy, one of Australia's oldest companies, were counting the votes to see if they could muster the necessary 75% of shares voted in favour of their proposal to split the company in two. Mike Cannon-Brookes' Grok Ventures accounted for 11.3% of the votes. He was a definite no and had campaigned against the split. Wilson Asset Management and Hester had already said they were likely to vote no as well. But then, according to those reports, a message came through. One of the other large shareholders in AGL, Martin Currie, was also voting no. And that was enough votes against to sink the AGL split. And that triggered the resignation of Chairman Peter Botten, the Chief Executive Graham Hunt, and two other directors. Reece Birtles is Chief Investment Officer at Martin Currie Australia, and he joins me now. Many thanks for your time, Reece. Did I get that chronology broadly right in your mindset, do you think?
It sounds broadly correct, yeah.
Yeah, and so just explain the thinking process, what your organisation went through to come to that decision to not go ahead with that split.
Well, ultimately, what we looked at was the long-term future of AGL and what was the best business structure for it. So if we think out 10 years and think about what sort of company AGL needs to be in order to deal with energy transition and a Paris alignment agenda, we really felt that a combined entity would give it the best strength to be able to achieve what's required in terms of managing the electricity price risks between suppliers and demand, provide the firming capacity to renewables as they come on stream and provide them the customer base as an offtake to really make new renewable investments a positive economic return. You know, and that's one of the reasons that a lot of renewable projects haven't got up, is because they don't have the end market. And AGL is really the strategic asset in terms of making new renewable projects work and aligning the timing with the closure of its coal-fired power stations. So ultimately, we really felt that the combined entity was the best position to do that. And we also we saw appeal in the idea that the combined entity with the right plans on coal plant closures could achieve Paris alignment as a whole. And that would really, you know, fixes one of the biggest problems that AGL was trying to look at when they looked at doing the demerger, which was to try and decrease their risks through that energy transition.
I was going to take you to that because one of the issues that you point out is that one of the companies that was to be created, AGL Australia, was to have the retail customer base there, the end users as it were. So you saw that as one of the real assets. If you are to be a generator of electricity, regardless of whether it's coal or what type of renewables might come in the future, you thought that that was one of the key assets for that combined business.
For sure, the customer base provides the certainty of demand and provides the offtakes for new renewables. You also need the firming capacity to be able to ensure that supply can be generated when customers need it, not just when renewables are generating. And so you need to be able to manage the portfolio on the demand and the supply side. And the big retailers are in the best position to do that. And finally, the other aspect that's really important is access to the grid and the sites. And so the existing sites of the coal-fired plants are in the best position to do that and are really going to form the basis of future renewable energy hubs and even hydrogen offtake. So AGL was a key strategic asset in that. The only thing I'd say is, you know, one of the things about the demerger was it wasn't really just that the retailer was a retailer without generation. What they really did was split retail customers with which also had some generation for renewables. And then they had commercial customers in Accel Energy with other renewable generation alongside coal-fired power. So they really were building two integrated companies, which, you know, wasn't really a split between generation and retail. And again, that's one of the reasons we felt it makes more sense to stay together.
And Jeff Wilson, when we spoke to him last week, one of those shareholders who was going to be against it, also noted the cost of the separation, the cost to advisors, more than $250 million potentially in those break fees. Is that another thing that at least boards and management have got to think about before they make such a transformational change to their business?
Well, I mean, yes, there's advisor fees and you know, they can be large, but I think one of the things that the company was really going through on that demerger process was a simplification and reducing the scale and complexity of the business as they broke into two. And I think in reality, shareholders will get the benefit of that even if the company stays together as a whole, because they've narrowed down their systems requirements, they've narrowed down head office costs as they're planning for that demerger. So I don't think all of that cost you're describing will be dead money in the end for shareholders.
Okay, then one final part about this is the future. Mike Cannon-Brookes, when we spoke to him, talked about if the coal-fired power stations in the future might find it difficult to raise capital, to actually raise debt to continue to support themselves. Is that an argument that you were conscious of as well?
For sure. I mean, one of the arguments has been that because of, for example, bank commitments to exit coal by 2030 meant that AGL would have to rebuild, repay all of its debt by 2030, which would put it in a very constrained position. I don't think that's really a reality. If you achieve a Paris-aligned plan, you'll get full financing support. And the other aspect is that many of those coal plans for banks to exit are really about thermal coal mining rather than coal-fired energy generation. And they do also need to look at the social implications of exiting coal too quickly, which could really disrupt the electricity grid and affect retail customer prices. So they'd be able to look at the whole situation and make a realistic assessment. So we think the combined entity can really work through the correct plans to keep financing in place, and there's plenty of investment available to support them in the renewable energy space.
I'll tell you what, good to have you on the program today. Reece Birtles is the Chief Investment Officer at Martin Currie Australia, voted against that AGL split, which didn't end up being a vote at all. And Reece, many thanks for your time on the program today.